Hey guys, welcome to the Good Stuff Podcast. I'm Derek.
And I'm Ashley. Both raised in Marysville, Ohio, we decided to stay here and raise a family and start 2 small businesses because we absolutely love our community.
We just want to take some time to celebrate the good people, places, and things here in our community that we love and share some of that good stuff with you.
So, enjoy the good stuff.
All right, guys, welcome back to another episode of the Good Stuff Podcast. Here, I have Mr. Ferguson with me, good friend, lender, that I've had the pleasure of working with recently. With the housing market the way it is, we thought, we're going to start a podcast and talk about all things in your homeownership journey and improving that. But more specifically today, we're going to talk about rates. We're going to talk about what rates can do to your home value, what it does to your purchase power, all those kind of things. So thanks for joining me, sir.
Absolutely. I know this is something that we've been talking about doing for a while, and I'm glad to be doing it with you. And hopefully there'll be more to come. I'm sure there will be more to come. So,
oh, yes.
So I mean, one of the questions I think you and I both see in the market right now, obviously the key word of the day is kind of inflation and how it's impacting the housing market and kind of what we're seeing out there. And I have, clients constantly asking me, what's the rate look like today, or, following up on a weekly basis. So I thought I'd do a little bit of a deep dive into, what kind of caused where we're at today, and how rates work, in a sense. So let's kind of going back to when COVID was at its peak. There's a lot of talk about the Federal Reserve and kind of their policy and how it impacts mortgage rates. Well, Jerome Powell, the Fed Reserve chairman, basically came out and said that during COVID that the inflation was transitory. So because we had huge supply chain issues, factories were shutting down because of workers that had COVID, those types of things. And so, that was kind of the Fed's outlook. And they were they had the effective federal rate was 0%, which is the rate at which banks can lend money to each other, essentially. So it was basically free for banks to lend money to each other, and the Federal Reserve was backing all of the mortgages, basically insuring the mortgages at that point in time. So let's fast forward to today. Inflation's been around for a little while, even though we've seen supply chains kind of ease up a little bit now that COVID is kind of, we're not out of it yet, but lifting a little bit. We're kind of easing back into a normal world. And so what you're seeing is the Fed will kind of come out and hint at some of the things that they're going to do when it comes to raising rates. So they will, hint that maybe they're going to raise the federal rate, a quarter of a point or half a point in May, which they just raised it by half a point in May.
So let's jump in and back up just a second.
Sure.
Because this isn't something I necessarily know, so I want your opinion. And so as you guys are hearing this, I'm learning some of this as well. And, it's all confusing stuff. So
sure.
I think one of the biggest misconceptions out there is the Fed is the federal government. There's no official tie, correct?
There's not. No, the Federal Reserve is supposed to be a non-political body that really drives economic policy. So what their responsibility is to find a balance within our economy, make sure inflation's not too high, make sure, employment is where it needs to be. And I think during COVID, during the peak of COVID, they wanted to make sure that the economy was as stable as it could be, which is why we saw interest rates at historical lows. And really, if you look at it in historical perspectives, still very low compared to, we had historic inflation in the 1970s, and we had, ask your parents, grandparents, we had, mortgage rates at 15, 17%, even in the 90s,
Which is crazy.
Yeah. And actually what we've seen in all of those periods is that when interest rates increase, housing purchases don't slow down within that time period. We've seen that on a historical level. So very similar to what we're seeing today, in housing, housing is continuing to boom, and interest rates are rising. So the Federal Reserve basically dictates and makes policy for just the economy. I mean, that's kind of their sole purpose. But the mortgage rates are really driven by the 10-year Treasury bond yield. So if you want to pay attention to something, if you're interested in what the mortgage rates might look like, I would say the number one thing to pay attention to is the 10-year Treasury yield, if you can, because typically mortgage rates are 1% to 2% higher than that as it moves, right?
1 to 2?
1% to 2%. So investors are kind of looking at bonds as a safe choice to invest in. And if bonds offer a higher interest rate, they're going to invest in bonds. Where if mortgages, mortgage-backed securities offer a higher interest rate, mortgages are going to, take off. So it is kind of a give and take. But the number one thing I would definitely pay attention to is that 10-year Treasury yield.
Perfect. Okay. So they've raised the rates. When was the first one? Like March? Beginning of March?
I believe. Yeah.
Beginning of March.
Yeah.
So since then, it's been a 0.75 increase, right?
Yep.
And so we went from about a little under 3% at the time from an interest rate standpoint.
Yep.
To today,
5.5, 6.
5.5, 6.
Yeah.
So on a side note, how much swing when in the context of, hey, Jeremiah, where is the interest rate today? How much variability is there in a person's situation from I got a good credit score, a bad credit score, I make a lot of money, I make a little money, I've got assets, I don't have assets? Is it a pretty tight window, or what's the fluctuation? I've always wondered that myself.
That's a great question. I would say it does make a sizable difference. It could be a point to a point and a half, depending on the situation that I see on a daily basis, depending on credit score, depending on the down payment, depending on the debt to income ratio and some of the other variables that go into buying or and getting pre-approved for a mortgage loan. I think there are 11 or 12 variables that go into what your
assessing
mortgage rate looks like. So I have, when I get those clients that come to me and they want to know what their rate looks like, the first thing that I ask them to do is let's get you pre-qualified, or let's get an application to look at so that we can, so I can really be as accurate as possible with what rate we're looking at. Right. Because it does make a world of difference depending on, credit scores, things like that. So those are definitely things to pay attention to.
What would you say is the most important of the 12 or of the, the major factors that go into what your rate is? What do you think, in your opinion? Or
it's a good question. I would say credit score is definitely one of them. Fun fact, when we look at a pre-qualification, we pull the credit scores from all three bureaus. So TransUnion, Equifax, and Experian. And so what we use for pre-qualifying and to pull rates is we take the middle score. So whatever the middle score is of those three is what we use to determine what that rate's going to look like for pre-qualification purposes, those types of things. So I would say credit score is definitely up there. There is a really important factor that goes into buying a home called loan to value ratio. And what that is how much is your loan versus how much the home is worth, right? And that is either the lower of the sales price or the appraised value. So the more of a down payment that you're able to put on your home, your chances of getting a better interest rate are definitely going to be higher.
Gotcha. Is there a point where that stops?
I would say it. Yeah, once you
returns?
get past 20-ish% or so, it tends to not matter quite as much. Anything over 20%.
Then the bank's numbers are good, and it doesn't really improve the situation.
The risk portfolio of the file, is lessened. Obviously, if you're putting down a sizable down payment, the risk of you, foreclosing or something along those lines happening is very minimal, right? And typically, if you're putting down less than 20%, sometimes you'll have, most of the time you'll have what we call mortgage insurance, PMI is what it's referred to often. So PMI is something that you're paying for on a monthly basis until you reach that, 80% threshold to basically protect the bank against something happening, as a result of, a correction or something along those lines. So luckily, we're in a pretty strong economy right now. Foreclosures are very low, which I'm sure you're seeing, one of the biggest things that I think is factoring into home appreciation levels right now is just supply and demand.
Sheer supply and demand
is what you're saying. And so we're not builders aren't building as many homes as nearly as many homes as what we would need for the supply right now. I think I heard something the other day that we would need, builders would have to build 5 to 6 million new homes across the United States to catch up to demand, which is just a astounding number. So you've got a lot of people sitting on the sidelines right now, really wanting to buy. And I think it's a great time to do that if possible. And I'm still learning every day. I mean, it's just one of those things where there's so many variables and so much to it that, it's just an ongoing learning process. And guidelines change, they change. And one of the things that I would say, also, if you're looking, at buying a home and you're working with a lender and, you want to get pre-approved, look at the APR. That's something that I don't think gets talked about very often. But
it's kind of one of those clouded, I know it's the interest, but it's hard to really understand.
So the APR is basically the all-in cost as a percentage of the loan. So what you're seeing today and what I've seen a little bit of is that because rates are a little bit higher, most people have the ability to buy down the rate at closing. So you can actually pay, a percentage or two of the loan at closing to buy down your rate if you want to do that. But they're, based on the rates and the way the market is right now, there are instances where that's kind of being baked in as a closing cost. And so one of the things that you really want to pay attention to when you're getting pre-approved is not only the interest rate, but the APR. Look at what, the all-in cost of the loan is.
Is that kind of a generic, I assume the purpose of implementing that, I assume at some point there was a situation where the regulatory body said, let's throw something in there that's a little easier for consumers to not have to do all the math, but they can say, here's one number compared to another place. So you might be, points and servicing charges or whatever, but the cost of the loan being baked in that's kind
exactly. I think, I don't know exactly what drove, that to be implemented, but I think at the end of the day, there probably came a point, and it's still, the number one question I get asked, I think, on a day-to-day basis is what's the interest rate, right? Because a lot of people I don't think know about APR or what it means. And that's not to the fault of anybody. You wouldn't know, right? Because interest rate has become just such a prominent aspect of buying a home. It affects your monthly payment. It affects your buying power, those types of things. So by no means should you ignore the interest rate, but it is a good idea to take a look at the APR as well, just to make sure that you're getting the best APR possible when you take into consideration not only the interest rate, but the origination fees, the underwriting fees, all the fees that go into a typical loan. Just two great things to look at, I would say. Yeah.
Perfect. Okay, so let's start taking that more to a consumer-focused, what's it mean to all of you out there? Why are we interrupting your day to tell you about mortgages and housing? So I think one of the biggest things that's coming through is now the right time to buy? That's one of the things we get asked. What's the interest rate? Is it a good time to buy? In terms of, is the rate going up? Should I buy before it goes up too high? Is the real estate market, is the housing market going to crash? And all of this. In general, I want to start by saying, if you need a house, now's the best time to do it. It's only going to get worse. One of my quotes I enjoy applying to life a lot is, when's the best time to plant a tree?
Yesterday?
20 years ago.
Yeah. Right.
But
right.
yes,
Right.
In the past. And what's the next best option?
Yep.
Now.
Today.
Yep. Housing, I think in general, a lot of people will ask, where's it going? Should I wait? In general, housing always goes up. Yes, and a lot of the experts that I've observed lately talking about this topic that have a lot more knowledge and a lot more experience in it say, if you've only experienced the last recession, the 2008 housing-caused recession, which I think our age group and younger, that's been their exposure to recession.
Exactly.
And so everybody's kind of burnt by that, thinking that housing gets affected. Well, housing caused the Great Recession. Most of them don't affect real estate. I believe it's the last 6 of them. Only 2 homes have depreciated in value. The Great Recession, and the other one only depreciated by about 2%. So not really depreciated at all.
Right.
That's kind of a normal flow. So I think all in all, things have been crazy for the last handful of years.
100%. Yeah.
And unfortunately, however you want to look at it, things are only going to continue to get worse.
Yeah. Yeah. I mean,
or better.
Yeah. And I get asked a lot, I think a lot of people are waiting for a correction or some sort of, crash or something along those lines. And I think one of the things that, from our perspective, as a bank and, as a lender, there are so many parameters in play right now that weren't in play in 2008. Mm-hmm. So the chances.
Yeah, that was one question I wanted to ask. Like, where are we at? That other than people having a lot of equity in their houses, which is one data point. What are the factors that are avoiding a recession caused by housing this time around?
Yeah, so I think, the number one thing, there were laws implemented after 2008. Dodd-Frank was one of them. Mm-hmm. But you have to be able to show as a lender a client's ability to be able to repay the loan, regardless of what type of loan program
why is that a
that you're
requirement?
doing. Because of things like 2008, if you look back.
Ninja loans?
Yeah, ninja loans, no income, no job, no assets, right? So you had, unfortunately, you had situations where you didn't have to turn in documentation and you didn't have to prove that you had consistent employment.
I heard somebody say a lender that serviced people back in that day, that if they needed to satisfy underwriting, they would print off a fake business card to submit to underwriting to show that there was a side business to create extra income. So we're saying we don't do that these days?
Yeah. And that doesn't surprise me, but we definitely don't. And, even when you look at underwriting, so there are so many, there are documents that we have to collect up front, like bank statements, W-2s or 1099s, and the underwriter, for anybody familiar or not familiar with that term, is a third party that has no interest in the loan, the bank. They are looking at the loan and the file as objectively as possible. So they have no interest or, in anything really. And so they, will send us conditions, and they really look at everything as thoroughly as possible. Mm-hmm. They're looking at your bank statements. They're looking at your income to see if there's any. No. Yes. Yeah. I mean, we could sometimes agree depending on the appraiser, but so they're looking at everything as thoroughly as possible, as they should. And so, that's one factor is on the lending side, we're doing our due diligence to make sure that, the client is truly pre-qualified and able to be able to pay that mortgage payment on a monthly basis. And it's a confidence builder also for the clients, right? To know that they're qualified and truly qualified.
Well, and qualified by somebody that knows what they're doing. I think that's a huge thing that kind of it's overlooked. Like you sent me a pre-approval letter for somebody that they were looking at about $250,000. You said, hey, they're up to here. And I think having those conversations with people of where are your numbers and, from a practical standpoint for consumers, having an educational standpoint from a lender being able to say, here's where you're at. This might put you up at your ceiling, but here's where your numbers are, because sometimes lenders won't talk through that with clients. And so,
I think, one of the most important things that I would say to anybody that's, in the beginning stages of getting, starting to look at a house or maybe, selling their house and possibly moving into a new one is not all pre-approval letters are created equally. Nope. There are, most of the lenders out there are wonderful and they do their due diligence, but I would definitely make sure that you're working with a lender that, is verifying assets and asks for bank statements and income upfront when they're pre-qualifying you, because the last thing that you want is to get into contract,
get halfway through and get
earnest
ruined.
Money on the table or something along those lines and lose it.
I had a client put down $5,000 in earnest money. It was a little bit of a larger transaction back in the day, and had a lender in town say, well, we didn't get to it, so just ask for an extension. I said, there's $5,000 of earnest money on the line here for this client. All right, well, just see what you can do. See if you can get an extension. Legally speaking, the seller can keep this client's money because you didn't do your job. It's amazing when you run across that. So one of the biggest pieces of advice I always try to give is unless you feel like you know what you're doing in all of this, find somebody you can engage with and that's going to engage with you, that's actually going to dive into it and do all the things that you're talking about. Otherwise, you might get into a position where you lose your earnest money. Or more importantly, I think the other thing that sometimes gets lost in all of this from a professional side is when people get treated as files, not as people.
Yeah.
And houses, and that goes back to kind of where this started. And the topic for me of this is the utility of a place to live and live your life. This isn't it's an investment, but first and foremost, it's a place to have your life.
100%.
So treating it as that through the transaction, and so having quality people. That's why I'm in this business. I can only assume that's part of it for you is the relationship and being able to
100
engage with people.
Yeah,
and
I mean. It's so, we live in such a digital world now, and I communication is so key to what we do, to both what Derek and I do. Making sure everybody is in the loop on when to expect to hear from you, how the process is coming along. And I get to know my clients so well throughout the process. And one of the reasons I love going to my closings is sometimes that's when I meet them. I spend 3 to 4 weeks getting to know this person and talking to them and, interacting with them. And so I think it's really important that you find somebody that you jive with and, that is, you have a good feeling about, and that's going to do a good job as far as the communication goes.
And
Absolutely.
just my 2 cents on it and kind of how I view interacting with my clients, and not that I'm perfect at it by any means. But people that I work with, if you only hear from them when they need something or when you ask for something, usually I don't know if they're going to go above and beyond. But if you hear from somebody when they're just checking in, continuing a relationship outside of a transaction, I know it might not sound like the coolest thing to, be friends with build a relationship with your professional associates or people you do professional things with. But to me, that helps build trust and kind of, to an extent, you can live life with people and know that they're there to take care of you. And maybe that's just my small town mentality.
Yeah.
But to me, if somebody's got your back when you don't need them, then they're really going to have your back when you need them.
Agreed. Completely.
So
I think one of the things that we've talked about is, one of my taglines for my team is your lender for life, right? I want to be that person's lender, not only on this transaction, but, I think the average is, right now is people stay in their houses for about 7 years before they decide to sell and maybe move or upgrade to something different. Is it 10 now?
I just heard this morning. It used to be 7. Now numbers are saying about 10.
So people are staying a little bit longer, but I make it a point to contact my clients throughout the year. And, even with interest rates being up, I know it creates a little bit of anxiety for anybody out there shopping. But one of the things that I really often tell people is that you're not locked into that for the full 30 years. I mean, you are when you close and, it seems like, oh my gosh, I'm kind of cornered into this rate. But, it's important to work with a lender that's going to give you a call if something changes in your favor, right? And I think that's, the market fluctuates as we've seen, over the past, 40 years, 50 years. So anytime anything changes, in the client's favor, you can always refinance into a lower rate if that works out for you. But it's important to have somebody that's kind of got your back so that you don't have to pay attention to those things on the back end.
And even just touching base with people, you never know when their circumstances are going to change or whatever. And I think that's if there was one thing I wish people would do from a professional standpoint for real estate and housing, is when they call and say, hey, I've done a bunch of stuff to get ready to sell my house. Can you come list it? I feel like at that point, my value can't really be contributed as much as it could be.
Sure.
Because planning and preparing and doing those things, I think, is usually the biggest opportunity to help people. I mean, the paperwork and the marketing and all of that goes along with it is one side of it. But so anyway, I think, kind of like the tree metaphor of, being properly prepared to list your house is going to put you in a better position. It's going to be less stress. You're going to understand the process better because you've prepared for it and whatever. And so I think just touching base with clients and having somebody that does touch base with you, we as professionals can know where you're at. And maybe there's a situation that dictates preparation or a refinance for a different reason.
Agreed.
Or a HELOC or, whatever might come up.
Yeah.
So it's not just with rate changes and different things that might be advantageous for you. It might be your situation changes and, sometimes there's avenues this way.
Well, and lenders offer different products. One of the biggest things that I get calls about right now are bridge loans. from your standpoint, timelines are a huge thing when you've got people want to buy a house before they sell or list theirs. And then you're in this situation where you either have to extend your closing out to be able to sell your house and draw the funds, from that closing to put down on your new house. So, that's a product that not everybody has. It's something, that we offer where, we can put it on the pre-approval letter to say, hey, this offer is not contingent upon you selling your house, right? And so,
which is huge, by the way.
Yeah, and it gives you some time, right? To get, it's buying a home is an emotional and stressful situation in itself.
Yes, sir.
And then listing yours and getting it prepared for showings and those types of things is stressful.
Well, and to second that, that's stressful, but easy because people want a listing. So the emotional kind of jump from, I'm going to sell my house, prep my house, not to interrupt you.
Yeah.
And then you're going to go on the other side of the coin and be the buyer where you have to compete and beg. And I just heard an agent earlier today tell me for a house in Marysville, not like a mansion or anything, as part of their offer, they offered the sellers an all expense paid trip to anywhere in the U.S.
No way.
For like a week or something.
Really?
And their offer wasn't accepted because legally there was no like guarantee to it, because it's kind of a pie in the sky,
right?
Not a normal thing, but just crazy situation that is anyway. So just
yeah, and
going on the emotion and
to
stress.
go back, and there's things like appraisal waivers that some lenders have the ability to kind of it's not something a lender can guarantee, but depending on the circumstance, if you're putting down, a sizable down payment, if you've got a good credit score, and if you live in a neighborhood or you're buying a home where there's, comps that are, more recent, you can have an appraisal waiver. And appraisal gaps, you see those all over the place now where, it seems like, a lot of homes right now are going above list price, and
the average right now, FYI, 5% over asking price 5%. As of this morning for the last 30 days.
Yeah. In Columbus, we're seeing, homes go for $40,000 to $100,000 over asking price, on a day-to-day basis. But again, it goes back to the demand, right? It's just, there's just not enough supply on the market, and there's just a ton of people that are wanting to buy. And
there's only going to be more this year, FYI.
Yeah. And I can't blame the people that want to rent, but if you look at renting historically, a home is an asset. It almost always appreciates over time. Renting,
if you take care of it.
Yeah. With renting, you're not really putting your money, towards an asset per se. Obviously you've got a place to live and that's wonderful. But you're starting to see rents rise as close or more than where homes are appreciated.
More,
yeah. So you have a lot of people kind of being forced into, hey, we've got to either look for a place to live or, find a place to rent. So tough situation for many, but listen, I would say, and you just alluded to this, there's no better time to buy than now. I mean, in my opinion, I think, the market is, it's only going to appreciate. I mean, there's news, in Columbus, you see building all over the place that the Intel plant is coming to Columbus. And I think especially in this market, especially in this area, you're going to see, time's out at 20 minutes. Oh, okay. Minutes. Okay. Oh, has it been 30 minutes? Holy cow. Okay.
Yeah. All when you're not watching the clock,
we can wrap up.
Yeah. 20 minutes. I was like, okay, I'll wrap up.
Yeah.
Oh, now it's another
10 minutes in. Yeah.
Yeah. So yeah, definitely the Intel plant and all those things that have come, or are coming in the building. It's now's the time to buy. To kind of sum everything up, definitely the time to buy. Interest rates are gonna go up or down.
I think what we've seen, and to kind of wrap up my conversation about interest rates, what we've seen is that there was a lot of anticipation of the Fed increasing rates, and a lot of that was baked in. We saw interest rates move very quickly in March and April. Obviously, the Fed has only increased by a quarter of a point to, or
three quarters
of a point. But you've seen interest rates rise, 2 points. So there are forecasts of, maybe there will be more than 6 rate hikes from the Fed this year, but that's kind of been baked in already, So
which caused the expedient rate
exactly.
climb.
And yesterday we saw an improvement in rates, and so it worked. We've kind of hit, in my opinion, this it's stabilized a bit. Will they go up a little bit more? It's definitely possible that they will. But I think a lot of this was baked in at the beginning, as the Fed tries to fight inflation and kind of, tame it a little bit.
Mm-hmm. So moral of the story, time to buy a house. If you need a roof, if you're trying to play the numbers and play the market, unless you're an expert, I don't recommend trying to, invest in property and whatnot. Unless that's what you're trying to get into. If you're just trying to do it on the side, I'm not sure if that's a great thing to do necessarily. I don't know. But if you know what you're doing and you're really invested in it, yes, real estate's always going to go up.
Absolutely.
Just like buying a house to put a roof over your head as the most important thing is going to be a good idea. If you want to rent, it's a different story. But as real estate professionals, we always advocate buying a house because that's what we do, and partially because we believe in it, and that's a good
and it's
thing
worked
to build.
out for both of us. I mean,
Yeah.
Personally for me, it's been one of the best decisions I could have made from early in my life on. It's I'm so glad I did, and I'm sure that a lot of people can say the same thing.
Yep. So to wrap, last comment. If you're going to start, you might as well start now. It's not like there's going to be a crash predicted anytime soon. So move on forward, buy a house. Obviously, we'd love to help you out, but reach out to a professional. Get educated. We obviously enjoy talking about this as we're doing now. So either of us would be happy to communicate with you, answer questions, or grab a drink here or there. Okay, so since we're going to continue this conversation on our own real estate related podcast, but this is the Good Stuff podcast.
Yeah.
So normally I didn't prep you with this. Normally we have a Good Stuff challenge.
Okay.
So if you were to, basically I'm going to, I like working out in the shop. So I am going to build some window boxes this quarter to give away to people to put window boxes up and have flowers and whatnot, partially because I have to build some for my wife. So
yeah,
figured I'd just do another set as a giveaway. But anyway, people that participate in, doing some good stuff and helping build community, or the other thing that gets you in the running is to write a local review for somebody in the local economy. Obviously, I'd prefer you write one for me if we've done business together.
For sure, yeah.
Or for you, sir.
Yeah.
Because we both appreciate that. But to go back to building relationship and engaging with our world, what would we've obviously had a variety of buy some pay it forward, buy something for the person behind you.
Yeah.
But
yeah, I mean, one of the things that I do on a consistent basis, hopefully this answers your question, is I'm a volunteer at the Dream Center, which is actually in Columbus, but it's a we meet once a week to help feed the homeless population up there, and it's really great just to shake hands and hear stories and see smiles on faces. So that's something, that hopefully falls into the good stuff category.
So if it was a challenge, you challenge people to go out and volunteer.
Volunteer if you can. I mean, it's free, and it's I think one of the most soul lifting things that you can do is give back, to your community and to other people.
Yep, for sure. I have heard scientifically proven that the only two things that are scientifically proven to guarantee an uplift in your spirit is serving others and learning something.
I agree completely. I couldn't agree more.
By science.
Yeah, that's right. Yeah.
Awesome.
Yeah.
All right. Well, this is maybe going to be our first 36 minutes. We're just shy of.
Yeah.
I'm going to say 40 minutes would be a good one, but anyway, I like to ramble a little too much.
Same.
But thank you, sir. I look forward to continuing the conversation, and see you guys next time.
Thank you.